Think about the apps that run your daily routine, services you rely on to order food, catch a ride, or scroll through short videos. Many of these global behemoths share a distinct origin story. Before they were household names, they reached a specific, coveted milestone. They became unicorns, privately held startups valued at over $1 billion. The name was chosen for a reason. In 2013, venture capitalist Eileen Lee analyzed over 60,000 software startups from the previous decade and found a tiny elite fraction that crossed that billion-dollar threshold, just 39 companies. Look at how this timeline has expanded today. There are now more than 1,200 unicorns globally, holding a collective valuation of over $3.84 trillion. But assigning a billion-dollar value to a young tech company requires a leap of faith. You cannot calculate their worth by looking at an annual report, established revenue streams, or past profits, because usually those don't exist yet. Valuing a mature legacy corporation is a straightforward calculation of physical assets and reliable cash flow. Valuing a startup still trying to acquire its first real customer base is entirely different. Let's look at this diagram to understand how a post-money valuation works. If an investor purchases a 20% equity stake in a startup for $200 million in venture capital, the math dictates the total company is now worth $1 billion on paper. Now watch what happens when we apply this to a giant like ByteDance, the parent company of TikTok. They have raised $13.1 billion in total equity funding. Yet through this valuation multiplier, their post-money value stands at a staggering $360 billion. To secure that kind of initial cash and generate such an enormous paper multiplier, a founding team has to convince their investors that massive exponential growth is an absolute certainty. Earning that level of trust is never an accident. It requires executing a highly specific 4-pillar structural blueprint. Venture capitalists do not hand over hundreds of millions of dollars for a minority stake based on a good idea. They need proof that the startup is engineered to completely dominate its category. The first requirement is disruptive innovation. A unicorn must break an existing market monopoly. Stripe achieved this by targeting legacy payment processors, introducing a seamless online payment gateway that allowed millions of small businesses to instantly accept transactions. The second requirement is a technology core. This chart breaks down the product focus of billion-dollar startups, showing that roughly 87% rely entirely on software. Software is mandatory for these valuations because it is the only product type that allows a company to scale infinitely without facing proportional manufacturing and distribution costs. Following that need for scale, the third pillar is consumer focus. If we reconfigure the data, we see that 62% of unicorns operate exclusively business to consumer, aiming to embed themselves in the daily lives of billions of people. You see this sheer volume in companies like Roblox, which maintains a creative sandbox for 164 million monthly active users, or the Chinese social app Kuaishou, which engineers extremely deep engagement metrics to drive its e-commerce revenue. The fourth and final pillar is blistering speed. On average, a startup undergoes rapid, massive funding rounds to punch through the $1 billion barrier in just 5 years. By combining disruption, software scaling, mass consumer access, and rapid funding, a startup can stay far enough ahead of traditional competitors to justify the immense financial risk their investors take. Historically, there was only one path for a company to reach a billion-dollar valuation. It had to offer its shares to the public through an IPO. Today, startups with a strong founding team can raise astronomical amounts of private capital early on. This allows founders to hit those billion-dollar milestones while retaining absolute private control over their operations. This dynamic has created immense unlisted private entities. Consider China's Ant Group. Its core product, Alipay, serves over 1.3 billion customers and 80 million merchants, netting the company a $200 billion valuation, all without trading on a public exchange. Remaining private allows these massive organizations to bypass the standard regulatory scrutiny required of public markets. In fact, Ant Group nearly left the unicorn list in 2020 by attempting an IPO until Chinese President Xi Jinping personally intervened to scuttle the public offering. Because private capital is now highly abundant and mobile, the tech industry is rapidly decentralizing. The finish line is no longer strictly tethered to Silicon Valley. Look at this map of the current ecosystem. 10 different nations, from Israel to South Korea, now host at least 10 distinct billion-dollar startups. We are seeing regional giants emerge that break the traditional American mold. Nubank has grown to a $41.5 billion valuation by offering digital-only banking across Brazil and Latin America, while Singapore's Shein built an end-to-end global supply chain to capture the Gen Z e-commerce market. Over in India, Reliance Retail leverages an immense physical network of 14,000 stores and access to a rapidly expanding population to secure a $63.4 billion valuation from foreign investors. The billion-dollar valuation is no longer an isolated anomaly reserved for the San Francisco Bay Area. It is a highly competitive, reproducible global formula, available to any founding team capable of executing it at speed.